Oh, hello everyone. Hope you're all doing okay. Thank you for joining us this morning for our virtual seminar. Those of you that don't know me, I think I recognise a few of your names. My name is Nikki Toomer and I'm the Customer Relations Manager here at Carpathia Grange in Hythe. I'm also with Robin Hill, who is also Customer Relations Manager in Ferndown in Bournemouth. So I don't know if you just want to say hi, Robin, there.
Good morning, everyone. Thanks for attending.
So normally what we would do in the care homes, we would have care fee seminars just to give potential residents and families information on anything to do with finances when your loved one or yourself are moving into care. And I've worked with a lovely Nikki over the years from Eldercare Solutions, and she's absolutely brilliant. She's got a super presentation ready for you. She will introduce herself in a moment. If you have any questions, then there is an opportunity for you to ask them at the end. This actual session is recorded. If you want to send it to anyone else, let us know also at the end. And that's it from me really. So over to Nikki.
Oh, thank you, Nikki. Very confusing with the two Nickys, I'm sure. Now I'm going to just share my screen. Hopefully that will happen seamlessly. She says, probably not, that might have been my family, you all got a quick peep of. So let's, hopefully you can see that. So Robin and Nikki are going to disappear off and you're left with me for about 30 minutes or so. And as Nikki mentioned, there's an opportunity to ask questions, but we need to do it via the text, the Q&A box, and then we'll pick those up at the end. Robin, I just need you on mute. I think I can hear a bit of background there. So roughly 30 minutes. Don't worry too much about taking notes. As Nikki said, it's being recorded, so there'll be the opportunity for catch up. But we also have a paying for care guide that we can send out to you, or you can download from our website, and that contains pretty much everything that I'm going to cover today. So apologies in advance. This is a generic presentation, and of course you all have your own individual situations, so there may be areas that don't quite get covered this morning, but we can pick that up offline, not a problem. So the plan for this morning, as I say, around 30 minutes, therefore I can't cover absolutely everything. So I've picked on the top 3 questions that we generally get asked by families on this topic. So the first one, who actually pays for a stay in a care home? If you haven't dealt with it before, then it's not always obvious how that works. We're going to look at whether a property has to be sold to pay for care. Again, there's a couple of urban myths around that. And we're going to look at whether there is, in the absence of any government action just yet, whether there is a way to cap one's own care costs. So that's the plan, and the graphic there is really just to demonstrate, I think, what most people feel when they enter the care system for the first time. So we're going to try and make things a little clearer by the end of this morning's session. If you take a note, by the way, the website address will stay on the slides throughout. You can contact us through there, or I'll give you the phone number and email address later. So I will formally introduce myself. Nikki kindly gave a brief intro there, but let's do it more formally. So we are a firm of SOLLA accredited independent financial advisors. SOLLA is really just the sort of gold standard for anybody that's giving advice in this arena. So while we are independent financial advisors, we do specialise exclusively in funding care home solutions. So whilst we have the qualifications to talk about mortgages and pensions, it's not an area that we practice. This is what we do all day, every day. Conversely, you could have an IFA of your own who does do lots of day-to-day advice around mortgages, investments, etc., but doesn't know very much about care fees funding. So I call them really 2 different disciplines completely. I actually set the business up myself a long time ago, back in 2007, and this was really just a result of my own family's experience of the care system, of my grandparents moving into care. we got no advice. We had no idea there was advice to go and get. And that is actually the usual problem. You think you're doing everything right and you're not aware of what you're not aware of. I became aware of certain solutions when it was too late. So as I say, the business was set up really an opportunity for me to get onto a soapbox, make sure people get the right information. What they do with that information is entirely up to them. But it's about making sure that you do know all options. So whilst we're here this morning at the invitation of Nikki and Robin, we don't have any commercial link with any care provider, but we do work with many because there are so few people that advise as we do. When you're talking about money, it would be very, very important to know that our firm is directly regulated by the Financial Conduct Authority. So very strict rules and regulations about us. Now, this morning I'm talking to you from a getting much sunnier Bishop Stortford in Hertfordshire, but we do cover the UK because even prior to lockdown, we actually did deliver our service by phone, email and post, and of course now Zoom. And that was more just to make sure that everybody involved in the advice process was really clear on what was said, that it wasn't a case of a meeting with one family member and that family member translated to another family member. Everything is there in black and white, an audit trail, if you will. So there's no area for miscommunication. It's such an important subject. And the good news for yourselves, any initial consultation that we have, phone, email, Zoom, any research of financial solutions that we might carry out for you, we do that at our expense, not yours. We found that people don't know what they don't know. They may not be the right type of people for us to help, or we might not be the right type of people to help them. So I think all of that should be done in an environment where people are not then liable financially. So there is a point in the process at which you would pay for our advice, but that's much further down the line, and it will be very, very clear and transparent to you when that happens. So that's a fairly long introduction, but I thought it's important you know a bit more about us if you were to talk to us further. So one of my three main questions was who pays for care in a care home, so meeting the cost of care. This is a very, very simple version. It is, of course, much more complicated than this in real life, but we'd be here for hours this morning if I were to go through the details. So I'm going to keep it simple and break the funding system down into three main streams. Someone's care is either paid for by the local authority, social services, the council, it's all the same place. They could be funded by the National Health Service, or they could be a self-funder. So there can be some crossover between these, but as I say, keeping it simple. So if we look at the local authority funding first, the key to getting any funding from the state, from the council, is that a person has to meet their care needs eligibility criteria. So an assessment has to be carried out and a person has to cross a certain threshold. Now, there will be some regional variance on this, and needless to say, that threshold has got higher and higher over the years. So people are having to be more and more poorly in order to qualify for state funding. Now, this has to come first. Conversations about money should always be coming second. And we have heard that that's not the case in reality, that sometimes the conversation starts with, do you own a house? And that's not how it should be. So the care assessment first, a person meets the criteria or doesn't. The financial assessment then takes place. And what they're looking for, this is, in other words, a means test. What they're looking for here is to see whether you have, the person going into care has capital assets above or below a certain threshold. I'm sure you'll have seen this figure banded around, £23,250 in England. In Wales, it's actually 50,000, so much more generous there. So that figure hasn't changed in, I think, 9 years. So in real terms, it's going backwards. So it's a very, very small amount of capital. If you have less than that and you meet the eligibility criteria, the state pays. Above, they don't. So let's look at what actually counts as capital. Well, I could be fairly flippant here and say pretty much everything, but there are three notable exceptions that I've pulled out here. If it's a couple scenario, then it's only half of something that you own jointly. 100% of anything owned by your partner, 50% of anything jointly owned, that cannot be included in that means test. Okay, so it is just looking at the individual, not as a couple. Your property, as you really would expect, I think, is also disregarded if a spouse or relative over 60 lives there. So again, we have heard of scenarios where perhaps a loan is put against a property when a spouse lives there. No, it's invisible, it is exempt, disregarded if a spouse lives there. As for the relative over 60, if that relative over 60 happened to move into the property the week before mum or dad moved out into a care home, then it won't work. That would be something that the local authority might call, it's a horrible term, but deliberate deprivation, where you're basically trying to bend the rules. But a genuine cohabiting arrangement, a relative over 60 living there, the house can't be included in that means test. Okay. And not so common, but always worth a mention because some people do have it. If a person has an investment bond that includes life insurance, so that won't be the sort of bond offered by Barclays Bank or the Abbey National, but might be the sort of bond offered by Norwich Union or Standard Life. It will have life assured written somewhere on the policy document. Those types of products, the value of those are not included either in a person's means test. So we have seen scenarios of attorneys rushing out to cash them in, and we always say with caution, you don't have to do that. You might choose to, but it's not included in the means test. Again, if somebody has never had these types of investment bonds and buys a load of them just before they move into care, then guess what? The local authority might call that deprivation as well. So they're the main exceptions. Otherwise, it is pretty much everything. It is your cash, your savings, shares, ISAs, etc. Income also counts as well. So the 23,250 is our gateway, that's our threshold. But when the local authority are working out how much they're going to pay for somebody's care, they will expect the individual to make a contribution as well. If you're a couple, looking back at that scenario again, and you have a private pension, that can be retained by your spouse, but the other 50% and your state pension goes towards that local authority contribution. Now, this is such a complicated area. I really have broken it down for the basics here, but the local authorities will have a limit on what they will pay. So you may have heard of lists of care homes that the local authority have contracts with. What they're supposed to do is assess somebody's need and then provide a care home place that will meet that need and fund it with, of course, the client contribution that we've just mentioned. But that shouldn't be an arbitrary figure, and there should be a genuine care home place available that doesn't require any top-ups by the family. So there should always be a genuine care home place on offer that meets the person's need, that is paid for in full by the local authority, albeit with the pension being paid towards it. If the family or the individual don't like the care home that's on offer and they choose to go somewhere else, that's perfectly okay, that can happen. But in that scenario, a third party top-up will usually be required. Okay, so that's important to understand. Again, some families think that when the local authorities say how much they'll pay, that the pensions, etc., go on top, and that's not the case. It is a combined contribution. So in great haste, that is the social care system, that is the means tested system, and that is all around people, as I say, that need some sort of personal care. Completely separate to this, as our second funding stream, is if somebody has significant healthcare needs rather than personal care, and that's where the NHS may pay for somebody. In really, really simple terms, I always sort of liken this to the fact that if you were in hospital having your care needs met there, it's paid for by the National Health Service. If it was similar care needs but being met in a different building, in a different setting, the NHS should still be paying for it. So it's around that. That's the way to think about it. Is it a complex healthcare need, then the NHS will pay regardless of what money you may or may not have. And they do use words like complex, unstable, unpredictable. There is actually a link on our website through to the NHS decision-making tool where you can see how they score people, what they're looking for. So it's quite difficult to get, I would say. It often is around the process not being followed. So lots of solicitors can help people challenge these assessments if they've not been done properly, but it is tricky to get. But it might be something that doesn't feature at the early stage of someone's care journey, but does a little bit further down the road. And there is actually a weekly contribution. If somebody doesn't qualify for the full funding, then they may just get a weekly, I think it's just under 185 a week, that's paid direct to the care home. So, but only if there is a healthcare need, as opposed to a personal/social care need. Okay. Again, another subject that we could talk about for a long time. So really whistle stopped there. So by the powers of deduction, if you're not eligible for the state funding because you have too much money, and maybe not eligible for the NHS funding, not being poorly enough, then all care costs have to be met personally. Now, the only good news slide really I have for you, and it's not that good, is that a self-funder is still able to claim or continue to receive a state benefit called attendance allowance. If you're not familiar with it, again, our website has information and the phone number to make a claim for this, but it's 2 rates, either £59.70 or £89.15 a week. It's paid direct to the individual. It's tax-free, it's not means tested, doesn't have to appear on a tax return, etc. And it's the difference really between those 2 rates. You're either needing attendance during the daytime or the nighttime, or you're needing somebody to attend to you during both day and night. That's the difference. And unless it's changed, the form is really looking for at least 20 minutes worth of nighttime attendance in order to get that higher level. So a couple of accompanied bathroom visits lasting 10 minutes, that would tick that box. So it's a really horrible form if you haven't filled it in. Very, very long, but fundamentally, if someone's in a care home, they'll get this. It's just whether it's the day or the night rate. And as I say, the only time that it stops is if the local authority funding kicks in. So as a self-funder, you absolutely can continue to receive this to help part pay the fees. The only other state benefit available for a self-funder, not for everybody, but for self-funders that have a property, then you may get some assistance if you're leaving it vacant. So if you were the sole occupier moving into a care home, you might get some help for the first 12 weeks, something called a 12-week property disregard. So you have to have less than the 23,250 in other funds in order to qualify for this. You have to meet their eligibility criteria, all the rules that we looked at before, and it will only be the local authority rate that is payable during those 12 weeks. So if you have chosen a more expensive home, a top-up can be requested during that 12-week period. So the point of this period was to give you time to think, well, do I actually want to sell it? Could we maybe rent it out instead? Because if you remember at the beginning, I said you have to sell a property to pay for care, and the answer actually is no, not in the individual's lifetime anyway. So you have this 12-week period to think about things, to decide what you want to do. Any money paid by the local authority during that 12 weeks does not have to be repaid. We've just seen a decision by the local authority ombudsman against Wiltshire County Council, who were telling people all sorts of nonsense about the 12-week disregard. So don't take everything you hear from the local authority as absolute gospel. Sometimes there is some training issues, should we say. So it may be that you have a think during this 12 weeks and you're undecided still what to do. And without the sale of the property, where does the money come from to pay the care fees? Equity release is not usually an option, if indeed you've heard of that product, that term. Most equity release providers will not lend on a property that no one is living in. It's as simple as that. So you might be taken with the idea of renting the property out, but the rent plus the pension plus the attendance allowance still might not be enough to pay the fees. So then what? Well, the local authorities, all of them, have to offer their citizens in the scenarios we've talked about, where you meet the eligibility criteria and you have less than 23,250, they can make a loan available. They call it a deferred payment agreement, but it is really just a loan. They have to do this. They can charge interest, but it's actually less than 2% at the moment, which is cheaper than any mortgage you would find. They do and can charge a setting up fee, but at the end of the day, they can lend you the full care costs that you're short by. So if you are 600 a week short, 500 a week short, even taking into account those other income sources, that's what you can borrow. It follows on from the 12-week disregard, and from week 13 onwards, yes, any debt that's owing will have to be repaid, but it can be repaid on the person's eventual death, so it doesn't have to be sold in their lifetime. So it's not for everybody. There's lots to think about: income tax payable on the rent, being a landlord, so on and so forth. But I'm just flagging it this morning because lots of people don't know about it and rush to sell the property before they've even given this consideration. Okay, so you now know. So our experience with the self-funding category of client is that the families have two main concerns. I think there are others, but these are the two I would pull out every time. They're really concerned about how to work. Can I afford this care home? Well, if you don't have a crystal ball and you don't know how long you're going to be in that care home, that's quite difficult to do any cash flow forecasting. So that's a concern. And the second concern is what does happen if the money runs out? Would the local authority take over the funding? Would my loved one have to move care homes, etc.? They're the two main concerns. Now, there is a solution that can, I won't say will, but can address both of those worries in certain scenarios. It's not for everybody. Absolutely not for everybody, but 85% of people don't know about it. And you remember I said right at the beginning, the experience that we had as a family, we were definitely in that 85%. And had we known about the solution, I can't say whether we would have taken it on or not, but we didn't know about it. And I think that's wrong. So what happens in this scenario? People don't seek advice. They sell the property. They might then take advice about investing the proceeds, but I tell you now, the guaranteed returns out there at the moment are limited, and anyone that is promising returns of 4, 5, 6%, there's going to be quite a degree of risk associated with that. So a good investment strategy might make the money last a little longer, but for Mr. Average, Mrs. Average, there's still a point at which they could see that running out. And that is what gives people the concern and not peace of mind. So I'm going to just enlighten you on that solution this morning. As I say, this is not a panacea. 60% of families that we write reports for, having researched this option, I think 60% roughly don't take it. So it isn't for everybody, but it's about knowing about it. So you can cap costs yourself. As we said earlier, the government has talked about capping costs but hasn't done anything yet. My expectation is it will have limitations. However it looks, the devil will be in the detail. So there is an option to do this yourself, whereby you can insure care home fees. Now, people don't know about this. People are unaware. It's a bit perverse. It's a bit like you wouldn't expect to be able to insure your car just after you've crashed it. You wouldn't expect to be able to insure your house after the bathroom ceiling has caved in, yet you can insure your care fees after you've moved into a care home. So it's not anything you can do in advance. You do actually have to have a care home bill, if you like, in order to even be eligible for one of these policies. But it's possible to insure those fees for life. The technical name for the product is a care fees annuity, but that word annuity, the minute you say it, people think about pension annuities, and that's a completely different product. It's priced differently. It's designed for people retiring at 60 in good health, living till they're 90. This product, it's based on that concept, but it is absolutely a different look and feel because it's for people much older with health conditions. The principle is swapping a lump sum up front for a guaranteed tax-free income. So in that sense, it's much like a pension annuity, but that's pretty much where the parallels stop. Every single case is individually underwritten, so there's not a rate table. If I have a room of 88-year-old ladies all wanting to consider the costs of this, the price for their plan, even though they're the same age, in the same situation, the price will be very different because their GP notes will be looked at. The care home might be asked to complete a report about their day-to-day care needs, and of course that will be different for everybody, their diagnosis, etc., etc. So when people ask how much will one of these plans cost, it's a genuine answer to say, I don't know. We have an idea, and I'll come on to that just at the end there, but broadly speaking, every price is different. It will depend what the client's shortfall is as well. So the care home fees might be the same for everybody, but everyone will have a different pension and a different funding gap, and it's the shortfall that generally we're looking to ensure. So the policies are fully portable. So if somebody did buy one for care at home, or they bought one to fund a particular care home, but moved, then they just take this income with them. It's theirs for life. They can build in indexation because care home fees will go up. They don't have to put indexation on the plan because, of course, that will make it more expensive. But we'd need to make sure that whatever was left in the pot, that could cover future fee increases. So you've got the option. We'll always get quotes with and without, so somebody can see what the difference is. Now, gamble is a strong word, but I would use that with these policies. They're really a gamble on somebody's life expectancy, and the gamble is going to be taken by some families and not by others. Some families will be worried about loss of capital if something happened to their loved one early on, and so on. So there are ways to mitigate that. There are ways to limit what you might lose. There are capital protection options, and there are deferred options. Deferred just means you pay a lower price for the plan now because it doesn't start for perhaps a year or 2 years, and that just means you lose less money if anything happened to your loved one. 75% of the insurers have also added a COVID cover, a protection that just means if you bought one of these policies and there were a COVID related death in the first year, you get all the money back. So it really is there to try and sort of genuinely give families the obvious comfort at this difficult time. So lots of different ways to mitigate the risk. There isn't a no risk option, because why would an insurance company do that? There'll always be the chance of the insurance company making money on this. But you see, insurance companies can afford to do what they call pooled risk, where they have hundreds and hundreds of clients, so they can make on some and lose on some. It'll all come out in the wash. When you're an individual family with just one pot of money, it's a different thought process. You have to think very carefully about the implications of what would happen if the money did run out. We call it the sleep at night test. Are you going to be more worried about losing the money if something happens to your loved one, or are you going to be more worried about that money running out? We can't make that decision for you. We can only provide you with the facts and figures. You would be very sensible to ask the question that if you were to buy one of these and something happened to the insurance company, it went bust, are you protected? Absolutely. You're protected by the same scheme that covers the money in the banks and building societies, but where they restrict the protection at 85,000, these have no ceiling. So it's 100% of the income that you buy that is protected by the scheme with no cut-off point. So they're as guaranteed as it's possible to get, really. And as I say, two main reasons people buy it. 60% of people don't buy it. They look at the price, they look at what they feel is their loved one's life expectancy, and they carry on as they would have been. They pay as you go and take their chances. But there are some families that really want that certainty of ring fencing the remaining assets. If I gamble this lump sum, it protects this percentage of the estate. And there are other reasons to buy, being the LA funding scenario. They do not want to be having conversations with the council in years to come about whether that care home place, that care home bill can be picked up by them, for all the reasons we've looked at before. If somebody were to buy one but later qualify for that NHS funding that I mentioned, then they would still get this income. It would be paid to them, but it would then suffer a slight tax charge. If it's paid to the care home as a registered CQC provider, no tax. If it's paid to the individual, there's a small amount of tax. Now, we are quite rare. I mentioned at the beginning that this is all that we do. Because it's all that we do, and we have that kind of volume of inquiries, if you like, we don't have to charge for researching this option. We have a very slick process. We know what we're doing. And we feel that if we were to charge you for finding out what one of these would cost, and you don't even know what one of these is really, and you don't understand the small print at this stage, that might put you off. That certainly put clients off in the past. And we really want you to have this information so you can make informed choices. So there's genuinely no charge for the research, but we do get paid a fee if a purchase is made. That will be built into the quotes that you receive. It might be a slightly higher fee than a non-specialist, but that probably makes logical sense to you. And also we have an advantage over the whole of the rest of the market. The whole of the rest of the market, if you find an advisor that understands any of what we've spoken about this morning, and they understand what one of these products is, and you ask them to research, they will be able to get quotes for you from this well-known household name, this lesser well-known household name, but nevertheless the company that probably secured until recently about 2/3 of the business, this well-known company that you may have heard of. Now, we actually as a company helped bring the legal and general policy to market only 2 years ago. They selected us to run their pilot. So that's where you'll get your quotes from any other broker. If you come to us, we will also be able to get you quotes from this friendly society because they launched a product last year. They also chose to pilot with us and they've been so happy with the way we deliver our advice, our customer feedback, that they're not rolling their product out to anybody else at the moment. Now, we never know in advance which of these four will be the cheapest, and whoever is the cheapest can sometimes be cheaper by 10, 20, 30,000 pounds. I mean, not insignificant amounts. So it's always really, really important to get all four to be able to compare, and we will do that for you. So in closing, if that product might be of interest to you, if it isn't, then hopefully the other information provided has been helpful and clarified a few things for you. If that product is of interest, the natural next question might be, well, you know, how much does it cost? And as I say, I'll sound like a politician trying to avoid the answer, because it is different. But what we've done on our website is we've put a very, very basic care annuity calculator on there. So all you have to do is input the age of the person. If they're under 80, they can still have one of these, but the data is not so exact. So the calculator only works for the over 80s. And if you know how much income the person has and how much the care home fees are likely to be, this will give you a very rough average. So at least you have a ballpark figure just to know, you know, really what it might be. We can then, with the medical underwriting, give you much more accurate quotes, but I think that could be a good start place. Also, as I say, on that website, you've got some frequently asked questions, you've got a contact us form, you've got the link for claiming attendance allowance, and you can download the guide that summarises all of this. So hopefully that will all be useful to you. It's a fairly new website. We designed it during lockdown to try and make the information much more accessible and easy to understand. So we'd welcome your feedback on that. So thank you so much for your attention. I talk fast, as you know, it's a big topic to get through, but I've managed to stick broadly to the half an hour, not too far over. So I shall stop sharing my screen. I can now see Robin. If you can see me, you're back in the room. And I'm going to just have a quick look through the questions just to see if any there that I can answer now. But Robin, I think you were going to just mention a couple of bits around the homes yourself.
Yeah, indeed. Thank you for that, Nikki. I mean, even those of us who are in the industry, it's always good to be updated and to hear things that can help our residents' families when they come to us as well, because as you'll all appreciate, it is quite a minefield in trying to figure this out. But with more and more people coming into care, I think it's more and more important that we give this advice out or give people the opportunity to do that. So thank you very much for the presentation, Nikki. If you do want further information on Care UK homes, specifically Carpathia, Grange, Hythe, or Ferndown Manor in East Dorset, then please do get in touch with us through the details that you have for this presentation. And it is worth saying that despite the current situation, we are still open and accepting respite and permanent admissions at this moment in time. As big an ask as that is at the best of times, this is obviously very different times, but you know, we're stuck with this for the time being. So we are here. Ask us any questions you like, get in touch with Nikki or get in touch with myself as far as admissions and any more information you might like from Care UK. And thank you all for attending today.
Thanks, Robin. Thanks, Robin. Nikki, I'll just jump in there. So I can see one question. There's a comment on the chat. Absolutely, just reminding us around the if you are going to rent a property. I said there are lots of things to think about, income tax, etc. But yes, absolutely, capital gains tax after the person has lived in a care home for 3 years. So that's a consideration as well. Particularly if you believe the rumours that the rate of capital gains tax might go up in the future to help pay for all the furlough support and lockdown support. So yeah, lots and lots to think about there, but as I say, it's just really flagging it so that people don't think I have to sell and don't have any other option. And Joanna, you've put a question up there: who can pay the top up? Can it be the individual or does it have to be their family? Now again, I don't want to confuse something that I tried to simplify. If it is somebody who is truly local authority funded, i.e. they don't have a property, they're not in on the 12-week disregard or the deferred loan, then in that scenario it does have to be a third party. That could be family, that could be a charity, but it can't be the individual themselves once they're down to that 23,250 threshold. Whereas if they are a temporary local authority funded individual, because they are getting the 12-week disregard help, then they can be their own top up. So very confusing, but I think you're probably asking in the scenario where somebody is genuinely state funded, then it does have to be a third party that pays that top up. So hopefully that answers that question. So that's the only one I can see up there. Nikki, you're not aware of any?
There was just a question before just about capital gains tax and saying, I don't know if you saw that question, Nikki.
Just mentioned that if you were to rent the property out, then the clock starts ticking. It becomes your second residence, as it were, after you've been in a care home for 3 years. So yeah, that's just something to be mindful of. But
so the presentation was brilliant, thank you. And certainly
welcome.
I've learned more information. It was quite interesting to see if somebody's care increased and their care needs and costs went over to continuing healthcare, that actually still they will get some kind of income from the policy. I always wondered that one, so thank you. That's a new one for me.
Oh, good. Well, thank you very much for arranging. As I say, my contact details are available through yourself, or if people have jotted details down. I've recorded this for you, so if you've got anybody that's missed it or any participants that want to share the link with family members, then I'll make that available today. Send you the link, and I think that's us and a wrap.
Right, okay, thank you everyone. If anyone does need information from myself or Robin or Nikki, do get in touch. We'll always try and help, even in an emergency. Do give us a call. Okay, thank you everyone. Bye.
Bye.
Bye.